Hey guys, it is Markets with May, and today we are going to be talking about American Express. Welcome back to Markets with May. And as you guys know, I've been very much so anticipating the consumer credit card companies more than the regional banks. To me, the regional bank story, given how much they're already going to be supported by the Fed and how much activity has already been done to demonstrate that this country was not going to allow another bank to fail, is kind of interesting, but not the main event for this earnings season in the financial sector. Instead, to me, it's been about what happens with all the other folks, namely consumer credit. And so today we had American Express and Discover Financial report earnings and give us that initial look, that initial insight into what's going on. Because the big question is this just a liquidity crisis, or does whatever is going on in liquidity start to impact consumer credit or any credit? For that matter. Um, okay, let's get into American Express. I listen to American Express and Discover Financial, Synovus, and a bunch of other financials. At this point, I think I've listened to about 12 or 13 financial companies report earning. That's my dinner. This is just a normal live cast. It's my vlog, guys. But I've listened to about probably 12 to 13 financial specific companies report earnings, and it actually looks pretty good. But we are starting to see little glimmers. And I'm going to focus on American Express despite having listened to the others. I'm probably bringing a little bit here and there, but I'll be very clear on what I'm seeing. Past performance is not indicative of future returns. I don't have a position in American Express. I haven't been taking one. I do have a position in a couple of other card companies, and I still have some residual positions in the banks in general and in financials in general. So that's full disclosure there. Woo! All right, let's get into it. I'm going to share my screen. Okay. American Express, before we really even get into it, it's kind of important to note with American Express that they represent a very particular part of the credit spectrum. Okay. Usually, American Express is going to have a much higher FICO score for individuals that carry an American Express just because of the nature of the type of business they're running. And also, they're going to represent a lot of the business community. And in a lot of ways, I want intelligence off of not just credit quality, but I want to know what people spend money on. And each of the credit card companies gives you a different intelligence. Now, unlike Visa and MasterCard, American Express became a bank during 2008 as a part of its issues, let's call it. And in a lot of ways, I think a lot of people don't realize that if you're not a bank and you have significant problems such that when you blow up, it causes other fractures within the system, the Fed and various regulators will ask you to become a bank. And so that's why I maybe have a different opinion than some younger analysts that have only been ever looking at financials post 2008. Unfortunately, that is emblazoned in my memory. Okay, so let me share my screen here. And the headline numbers I'll go through first, and then I'll talk about what I saw. On the headline numbers, it looked like hell. If I'm honest, right? It wasn't great. Okay, 14%. The number you want to look at, they just show net income, but I'm going to actually break it down a little differently for you. And the reason that I'm going to break it down this way is because the financials, for whatever reason, escape even some of the smartest people I know. And it has to do with the fact that for them, revenue is actually fee-based and net interest income based. And then sometimes there's an other. And as a result, they can't use the same words that everybody uses. So if you looked at the headline number, you might have seen something that said top line growth or revenue growth of 22%, and then diluted EPS of 12% or net income down 13%. And that's why the stock was down a bit on the quarter. Okay. That's not, you can't, there's a desire to put everything in cookie cutter. You can't quite do that. The numbers weren't nearly as bad as that looks, and I'll show you why. Here's the other way. This is from their Q. They're filing their earnings release today, and you can kind of see it's not from their Q, it's from their K. The Q hasn't come out yet, but sorry. So it's from the K, but also it would be in their earnings release as well. And when you look at it, I've divided it out to make it a little easier. This right here, this top part is fee-based income. Okay, I'm going to move it to the right so you can see the percentages of year-over-year change. And fee-based income was up 18%. Now, the second little baby part here, interest income, already titled, that's why I didn't go to town on it, was up 75%. What exactly? Interest income comes from loans, and the loans that we're talking about here are just credit card receivables every time you slash it in, right? And it comes from deposits with other banks, okay? And it comes from interest and dividends that folks are taking in. That's what interest income is. And it was up astronomically, up 75%. That's how you get a blended revenue income of this number right here, okay? The blended is 22%. It's this number right here. Should have put a little box around it, but it's here. Hopefully you guys can see net total revenues net of interest expense, 22%. Okay. Interest expense is actually cost of capital. So that's how you have to read it. You have to take the non-interest revenue, which is fee-based revenue, okay? Then you have to take the interest income, and then you have to subtract out the cost of that capital. So this total revenue net of interest expense up 22% is actually, if you were to try to force it into the paradigm of other types of financial statements, it is the equivalent of cost of goods sold, okay? Minus cost of goods sold. So it's your gross margin, 22%. Is what we're saying there, okay? It wasn't a bad quarter on that regard. Now, why then do you get a big fat L for earnings? Okay, that has to do with how financials report. And it's this other piece down here. Here, let me change the view so you can see it a little better because my head is right on top of it. If you look right here, okay, this is provisions for credit losses. And different companies do report it baby ever so slightly different, but usually it comes above operating income and ends up right smack there. Sometimes it's in operating income in some funky way. Depends on the type of financial. All right, hear me out. And if you look at this, this is provisioning for loan losses, which they did absolutely do more of this quarter, just as all of the card companies did, and quite a few of the banks, not all of them. Now we got to dig into that. We got to dig into both the cost of capital, and we have to dig into this other piece. Now, what I want to say about the cost of capital is kind of important, is that their cost of capital increased, but because it's a credit card, they just charge you that APR, right? There's not as much of a lag going on, but I do want to go through the balance sheet here a bit. I want to talk about expenses though, before we get into that. Total expenses were up 22% versus revenues up 23%. So it really is that provisions for credit losses that is doing the crazy on the numbers. And remember, provision for credit losses doesn't mean you took an L. It means that they just want to make sure they have some cushion for any kind of L that might happen. All right. So we're still making money at this point. It's just we're making less money than we were before because we want to make sure to provision just in case something happens to us. That's what's going on there. Okay. So expenses were up 22% versus revenue up 23%. It's not that bad. You can look through the mix. Card member services and marketing kind of did a swappy swap. So they're not necessarily trying to get new members. They're just trying to make sure that the members that are there stay happy and stay with them at American Express. So I just wanted to highlight that in case you're looking through this and like, what is going on? But essentially, business development, card member services, card member rewards, and marketing, they all trade places for what percent is who's going to be the top part of it. So realize that's the case. Now, before I get too much farther, I want to address this one thing, and then we're going to go through the balance sheet. What exactly is, actually, let me go through the balance sheet so you can see it. Okay, so here is the balance sheet. Hopefully you guys can see. I'm going to pull this up just a touch. But 42% of the financing is non-deposit related. Okay, so it's not going to have the same kind of weirdness that a typical bank has, even though American Express has a bank attached to it. And we're going to talk about that in a second because a lot of people don't even realize American Express, unlike Visa and MasterCard, have a bank attached to it. But what I want to show you here very clearly is if you look at the liabilities, the customer deposits, you can see 121. It's always approximately the same percentage. And the other two forms of financing they have is long-term debt financing and other. Okay. Long-term debt financing and other are the main way that they fund themselves. And none of this is a problem right now at this particular juncture, primarily because their business model allows them to charge you more in interest if they need to. However, you should keep in mind that long-term borrowing right now they've got it out for more than a year, so it's fine as far as that goes. But as the interest rate environment increases, then what we'll really want to watch for is the appetite for loan receivables from investors. Okay, right now it's okay, largely speaking, for specifically this type of very, very high rated loan receivables, that sort of thing. Okay. But it won't always be the case if we see deterioration over the coming quarters, which I'll show you in a second. The other is kind of this funky financing, I'm gonna call it. Some of it is lines of credit. Some of it is, some other organization that's happy to give it a line of credit. It could be a pension that's doing a direct investment. It could be a private equity firm that's doing a direct investment, and just asking for the receivables, hey, give me some of that juicy 10% yielding or 11% yielding loans that you're charging people that happen to carry a balance on American Express. So that's what that is. And that's how you think about reading through these financials. I wanted to spend a little bit more time than I usually do, not just reaction, but explaining what I'm seeing, because I know that for whatever reason, the financials of financial companies are magical and mystical, and they should not be. Everybody should be able to read them. It's just that I know that there's not a lot of great informational, instructional stuff out there. So that's how you would look at that. All right. Tier 1 capital for the quarter, not bad, to be fair. Okay. And I just want to highlight that they are, tier 1 capital has been more or less stable throughout the entire period of time and of this company. They always try to hold about 11.4%. And the reason that this is not going to be the major focus is because, again, it's not mostly deposits that we have an issue that cause are the form of capital that capitalize the loan, the ability to give loans, the ability of you to actually charge and there to be money there when you charge. Okay. It's mostly the debt markets that are funding them. I do also want to point out, in case y'all are doing other due diligence on this, the leverage ratio on a credit card company is always going to be higher. But guess what? Their capital is a bit more permanent than your typical bank. So a little bit increasing on a nominal basis, and that's just fine by me. Now, we should dig in to what's actually happening. What is the manner of which people are charging? According to American Express, these are the things that came out of the deck. People are just buying more. They're seeing their customers continue to spend and seem to have no problem with it. In other words, they're seeing it in the US, the consumer cards only. They're seeing it for commercial services, which is basically a company that issues a credit card to its employees. And then on international, it's even better. And they just to give you a little bit more depth, they do drill down. Here's consumer service billed business, and you can kind of see it by age category. Millennials, Gen Z, up 28%. Gen X, we're a little bit more conservative. We basically didn't have as much of a slowdown, quite frankly, during the COVID period. So our pickup isn't as aggressive. And then the boomers and so on and so forth. But they've really been targeting the younger market as we go forward here. And that is, everybody's spending. Okay. But even more interesting is the piece of the spend. General stuff versus, and they split out travel and T&E, travel expenses. Okay. This is travel entertainment. So we are absolutely seeing a huge chunk of it come from travel entertainment, and is growing even faster than just goods and services. Okay. Boring old goods and services. Now, if we look down here at commercial services, companies are absolutely increasing their T&E. Now, I want to say that this is a huge number, this 41%, but you have to keep in mind that the consumer recovered faster out of COVID than commercial services did. But thus far, even though the banking stuff all happened in March, we didn't see this massive slowdown yet as of the reporting here, which is really going to only include 2 weeks of the crazy cycle, maybe 3, depending on how you count it, 2.5, let's call it. International, though, check out these numbers. These numbers are huge, okay? If you look at the numbers for international, you'll see that the T&Es are up 58%. Okay, so This speaks to something that a couple of folks have talked about, namely the IBM call from last night said approximately the same thing. As bad as we think it is in the US, it's actually not as bad in places in particular like Asia, okay? And so realize that a lot of the stuff you got, whenever you're looking at global companies, you got to lift your head just a little bit, lift that chin up a little bit and see what's going on internationally to get a sense for it. That's part of the reason why I listen to certain companies even if I don't have a position. Okay, next area I want to talk about, losses. Okay, I care a lot about losses, but American Express, because of the nature of its customers, is going to show an ever so slightly different picture. American Express has shown me the picture of the business community, especially the wealthier business community, and also wealthy individuals, because it just is what it is for them. And you can see that the credit member loan and card member receivables, which basically is people holding a balance versus paying that off all together, has increased. Now, we don't get too excited about this because pre-pandemic in 2019, we were at 2.2%. And throughout COVID, we had the world's tiniest situation going on here. And here coming back up, given what we saw, which is just businesses are opening back up and spending and continuing to do so, this isn't that bad. All right. This is actually fine by me. What we want to watch in the quarters to come, just to make sure that there's no big issue, is we want to watch this 30 days past due. This has increased quite a lot. But again, like I said, it's off of really low levels. And the write-offs, this is probably the most exciting part, didn't move from the previous quarter. So we're not seeing real deterioration when it comes to loan loss receivables or what's going on. If there's no cheating in this number, in other words. Now, this is really important because you got to know that Discover did not have the same story to tell. Discover had a very different story to tell. And this is a slide straight from their deck. I'm not going to go through all the financials of Discover. Quite frankly, when you put it all together, Discover is probably okay. But like I said, this is a 2-quarter scenario because we only had 2 weeks to see what the impact of Silicon Valley Bank is across the entirety of the economy. Okay. So when we look at this, here's what's a little bit concerning. From the third quarter up, we're taking more loans. This is going to be certain types of companies because, you know, if you're using Discover, you're not using American Express, and you kind of can get a sense for what that means. Credit card loans. The blue line, you guys, the blue line is your net charge-offs. That's an actual L that the company has taken. The orange line is people just taking a little longer to pay their bills, so to speak. Okay. And we do see an increase just like with American Express, but you know, this actually is a little bit of a different picture. Okay. So we are seeing that pick up significantly faster at Discover. And then personal loans, you're seeing net charge-offs much higher, but whoever hasn't been charged off, whoever's still got a credit card seems to be doing okay on the personal loans, paying them on time. But, you know, this you got to just monitor. Student loans, lower net charge-offs, but kids are taking a little longer to pay off their loans or pay their loans each month. Okay. Again, Discover is really going to be that lower credit quality, not necessarily because people with a Discover card are bad in particular or worse. It's really because they specifically target college kids, right? So it's a very different type of client. You got a very different client at American Express because you're going to have to present a whole lot more documentation. Then you got everything in between, okay? All right, let's see what else we got here. This American Express, this is the last little item that I wasn't thrilled about. It's something to watch. Actually, there's 3 more items I want to just talk about. This is total provisions. This is not ideal, but it's not terrible. And what's not ideal, what's not terrible about it is the fact that pre-pandemic, their provisions were just a hair less than what they're provisioning today. I kind of like that they're provisioning it more today. The only thing I didn't like on this is that the write-offs were up significantly over the quarter. And a lot of times what you'll see if write-offs are up, you'll see the reserve build be equivalent to the write-offs. Okay. Now we know they took an L, so they could have just went ahead and gone for broke and increased this by 735. They did not. In fairness, if they've been reserving all along, and they did take, by the way, big, huge reserve during COVID that they've been slowly releasing. That's what this was. Okay. So they've been taking reserves through COVID that they've been slowly releasing. But that's the only little thing that I would say this isn't ideal. I would have personally liked to see them reserve more. That said, if they reserved a bunch and then nothing happened, they're just going to release a bunch. And so they'd be, borrowing from this quarter to pay for another quarter, and you'd see all kinds of craziness going on. But that was a thing. It won't matter if this is the only quarter that we see credit deterioration. If it goes into 3 quarters, really, but if we start to see a trend in the second quarter, the third quarter, then we start to be concerned. But right this minute, we're okay. This is, by the way, how I demonstrate what I meant on the last slide. These were the total reserves that they had against their loans. And you can see they're just a hair more than they had during the COVID period. So that's how they were showing, hey guys, don't freak out that we didn't do 700 million against our write-offs and or stuff. That's how they show it. And that's fine by me, but I wouldn't mind a little bit more conservativeness. And that's what's going on. Now let me take some questions. Hopefully that's helpful and was clear. Israel, welcome back. Thank you for always supporting me. Yeah, I'm a Chinese Italian girl, I guess, when it comes down to it. What do you want? Olga, thanks so much for stopping by. Let me see if there's any questions. Let's see how much credit they have left. I think American Express is probably going to be last one standing, even though, quite frankly, in 2008, they had to become a bank just to keep things a certain way. But that's a very different animal because in 2008, this was absolutely a credit crisis that rolled into certain kinds of other issues. Won't go into massive detail on that, but because the liquidity crisis got very severe, that's where American Express was like, I guess we're going to become a bank. If anything, I'd almost prefer they get rid of that bank and figure out other ways of financing themselves, or don't finance yourself and just be the credit portion like a Visa, MasterCard. Visa, MasterCard, as a function of having no loans on balance sheet, get a much higher multiple. And Dave Bigo, thanks. Manuel, thanks for stopping by. And Belle Biv DeVoe, wanted to give you a shout out. That's awesome. And that is it for this evening. We'll keep it short. Good luck in earnings season. So much going on. And I'll talk to you guys later. Bye.